Well, today I wanted to talk about developments in the market, prospects for the markets and policy going forward, and the outlook for growth. Let me say that on Monday, Westpac changed their forecasts for interest rates. Over the weekend, we saw some pretty dramatic developments, intervention by the Federal Reserve Chairman, who indicated that he was getting prepared to cut rates. Some of the weakest data we've ever seen out of China. In fact, the manufacturing indexes were weaker than we saw during the global financial crisis. And lots of discussion that the authorities, the regulatory authorities, the Commonwealth Government were in discussion over the weekend, indicating that we could expect to see some changes in monetary policy on Tuesday. So on Tuesday, Westpac moved forward its interest rate cut from April to March. And we increased our rate cut for the Fed from 25 basis points to 50 basis points. That was well ahead of the other major forecasters in the economy, both the major banks and most of the investment banks. On Tuesday, of course, the cut was delivered, and the Reserve Bank highlighted the coronavirus as being the key issue. Three main themes: coronavirus being important for a likely coordinated monetary policy response around the world, led by the Fed. Discussion of the Australian government, suggesting that the Reserve Bank expects the Australian government to also start focusing fiscal policy on the challenges, and finally the impact that the virus was going to have on the Australian economy in the short run. In terms of the fiscal policy, it's very important that Westpac has been arguing for some time that the Australian economy was weak even before the virus hit the economy, and a fiscal stimulus was going to be required, and we've been arguing strongly that the 2022 legislated tax cuts should be brought forward to 2020. We see that as being an even more urgent issue today. And we think that cutting taxes will boost household incomes, which will boost demand, and that's a better way to boost investment rather than providing direct tax subsidies for investment. Because if businesses don't expect demand to be picking up, then they won't be adding capacity, even if there's some tax advantage in doing that. So we're very hopeful that we will start to see some developments around tax cuts as a major response to the current situation. Of course, the Reserve Bank is likely to cut rates again in April, and that would have the rate down to 0.25%. That's the low point that the Reserve Bank Governor identified back in November last year, where he said we are not going to go negative. And at 0.25%, that means that the payment, the interest payment on banks' excess reserves would be at zero. So it's a zero policy, and that's as far as we want to go. So that would suggest that after April, there's no more scope to cut interest rates. And we have long argued that the quantitative easing would be the next stage of the policy, and that would involve the purchase of government bonds. And that will be an important policy to hold interest rates down, but more importantly, to keep downward pressure on the Australian dollar, because if other countries are still cutting interest rates and the Reserve Bank has run out of ammunition, the likely response from traders will be to want to bid up the Aussie dollar. So they will have to keep policy going in form of quantitative easing in order to keep that Aussie dollar down. The Fed delivered the 50 basis points sooner than we expected. In fact, they delivered it on Tuesday night, our time. We're expecting that there will be further policy easing, both on the interest rate front and on the liquidity front, and that will also assist the outlook. In terms of the virus itself, some people say these policies are not going to help with the virus, but they will help with easing financial conditions, and they'll help with easing the impact on the economy that the behaviour of governments and the behaviour of individuals that have to deal with the virus is having on economic growth. There are some positives that we're now starting to see coming through with regard to the virus. Although the spread of the virus outside China appears to be out of control at the moment in certain regions, but not right across the world, but in certain regions, we're getting some very encouraging signs in China. The number of new cases outside Hubei province is falling significantly, and the number in Hubei has stabilised at only about 500, where we were looking at thousands some weeks ago. I guess the best measure of that is that the Chinese share market bottomed out in the first week of February and is now up about 10%. So what we can be confident about is that as we go forward, China will be gradually coming back to work, gradually adding to demand and gradually boosting the economy. What we don't know, of course, is the degree to which it will spread outside China, and that remains the big question mark that no one can really provide the answer for. One little positive that I've been following is Singapore, because we know Singapore being a very hot climate, they've very quickly got their situation under control. They've only had about 100 cases, and in the last week only reported about 12. So hot climate is an encouraging sign, and as the European climate starts to heat up over the summer, that may provide some relief to the virus effects. What we do know is Australia's coming into winter, so that particular benefit will not be working for Australia, so we need to be very mindful of that. Thank you.